91.3 KDKR, Decatur, Dallas, Fort Worth, and KYJC Commerce.
Portions of KDKR's daily programming do not necessarily reflect the views of the management or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, with rising interest rates, what types of home loans make sense? Today we're going to take a look. Stay tuned for Prudent Money. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today, and you know I do appreciate it. Well, if you're going to buy a house, you're painfully aware that interest rates have been on the rise. What are your options? Well, today, mortgage consultant and Prudent Money contributor Mark Pfeiffer is here to weigh in. Mark, always good to have you on the program.
Always good to be here, Mr. Bob.
I got to tell you something, Mark. I was interviewing, I don't know if you know her or not, Cara Lee Gurney. She's a realtor here in town. And one of the points that I made was that I don't think we stop and take a look at and consider that we are in unprecedented times, let's just say in a lot of areas, but let's just say when it comes to real estate, with the things that are happening. And the one point that I want to make before we get started, because I was just thinking about this, how important it is to get with the right professionals, because this isn't just about writing a mortgage. This isn't just about selling a house or buying a house. This is about getting the right the right deal together at the right time, given these unprecedented scenarios that we face, and making sure that you are not making a mistake. I mean, there's just so many. I think there's a lot of mistakes can be made. So very, very important who you put on your team, and make sure that you're getting really taken care of.
It absolutely is, Bob. And I know you and I we're very similar in this philosophy too, which is, in life, guys, you do get what you pay for. And so a lot of times I'll see folks that are, pinching pennies to, leave one person for another to save $50. But the reality is, we're talking hundreds of thousands, $400,000 or $500,000 home, if not bigger. And so the reality is, having the right person will save you more than you even know. Right. So I was looking at something earlier this week. I think it was yesterday. There's one fee that they didn't put on there. It's mandatory for the particular program. It's a $7,000 fee that the other lender didn't put on that worksheet. So it's, I don't know if it was by accident or if it was intentional, but regardless, had the borrower decided to move forward with that particular lender, and I'm not saying that, they're allowed to be human. Of course, there's mistakes can be made, but the reality is having the right person, the right team is imperative to make sure you can know what you're getting and just getting the right product, because the lower cost and the wrong program will end up costing you a lot more in the future. There's no doubt.
Well, and the point that we make quite often, and we'll talk a little bit about this later, is that everybody in the mortgage business is dealing with the same numbers. So there's not one mortgage person who can get this screaming deal that another one can't get. And so I think we forget that sometimes because of all the very clever marketing that happens.
Well, and you're right, Bob. And so again, Fannie Mae and Freddie Mac, those are the mortgage giants that kind of set the guidelines, set the rules, and for the most part, again, there might be minor exceptions with banks that'll do a portfolio loan or something like that when it's their money, but generically speaking, they're all going to the same well. And drinking from the same water. So the reality is, if you find the difference between a lender, for example, and I know we'll get to this, today's rates are better than they were on Wednesday, or pardon me, on Tuesday. So it's one of those things where sometimes they're just not comparing apples to apples. And so I think it's just making sure you're being an informed consumer. But again, back to the first point, work with somebody you know, like, and trust, because at the end of the day, as much as I hate to say it, Bob, my market's become a bit of a popularity contest or a commodity, right? Because you can call me and call 7 other guys or gals and get something very similar, because we are all going to the same source of money.
Let's talk a little bit about a subject I don't think we ever have talked about when we've done interviews together, and I thought we would give it a shot, because this is definitely something where you want to have visuals with, so there's a little bit of a challenge to do it on the radio. I want to talk a little bit about the 10-year Treasury bond and the 10-year Treasury yield and its impact on mortgage interest rates. In your best layman's terms, explain how someone can watch that indicator and understand what is happening with mortgage interest rates.
Absolutely. So generically speaking, that 10-year bond, it moves. Again, most days, most times, it correlates with mortgages, right? So when you see that move up, we move up. When you see it come down, we move down. So generically, you might see that spread between mortgages anywhere from, let's just say, an extreme 1 to 2 points. So if the 10 years is, let's say, 4% or 3.5 today, but let's just say 4% where it has been about a month ago. In the past, you would see rates maybe, the 30-year fixed rate mortgage be somewhere around a point to 2 points higher. So, some markets it's a point, some markets maybe it's 2, but right now we've seen in this market, just because of just the disconnect, literally 3 points higher. So when the 10-year Treasury was at 4, you saw FreddieMac.com reporting rates in the 7s. So that right now, while they still correlate, but it's just the severity of that movement up is steeper when it comes to mortgages right now. So even today, when you're sitting at 3.5 on the 10-year, rates right now are still around that 6.5. Freddie Mac just came out this morning, as they do on Thursdays, shows 6.49. So it's about 3 points. So if somebody were to say they're watching rates, how do you watch it without having an advertisement or a commercial to get a phone to ring? That 10-year is a pretty good indicator of where rates are going or have been. And, in today's market, it's about 3 points higher. But that's not always the case, but that's where it's been as of late.
Well, let's talk a little bit more specifically about that. I looked it up on the 10-year chart. About 40 days ago, the 10-year yield was over 4%, kind of hit the high for the period of time. Now we're down pretty good below that number. What have mortgage rates really how they performed during this same time period of about 40 days? Have they really come down, or they just kind of drifted down a bit?
It's like I said, interestingly enough, it's pretty much a step for step. So to your point, like I said, when the Treasury was hitting 4%, and then I know it hit up as high as 4.3. When it was at that 4% rates, home rates, 30-year fixed rate mortgages were at the 7s. So 7%.
So how high did mortgage rates get there when it did get up to about
7 and an 8? So that's where it's interesting. So there are, hey, if somebody doesn't want to pay points, because again, Freddie Mac shows typically, and they just started doing something different, so now they don't show those points anymore as of about a couple weeks ago. But they would show at the time it cost you 0.8, 0.9 points to get a 7 or 7.125 rate. So now that they're down, again, the Treasury's down to 3.5. Rates are back down to about that same 6.5 range. So they've moved step for step with them. But again, at some point, and this is where I think it'll be early next year, I think you'll see that gap narrow back to something a little more normal, where you will see rates for mortgages will come down faster than the 10-year. And I think that's going to be in the Q1 and Q2 of next year.
Okay, so where are we today?
So Freddie Mac just showed 6.49 on their website today. They update it once a week. Rates do change daily, but this is the one website you can go to on the internet that's not trying to make the phone ring. It's FreddieMac.com. And so Fannie Mae, Freddie Mac, again, the consumer, myself included, we can't just go to Fannie and Freddie get mortgages. These are the mortgage giants. That's coming from a survey they do, and it's not perfect, but it's a good indication of where rates are.
Okay, so let's talk a little bit about the real estate markets beyond the mortgaging aspect of it. I was talking to Carol Lee the other day, and she described it. I thought this was interesting. Is that if you look at the real estate markets, they look more like a normal market would look. What is your read?
Yeah, it's interesting. I mean, what's funny is the market, we as the market as a whole, not just professionals but the consumer, we've kind of forgot what normal looks like. I get homeowners that freak out and they say, man, It's been a month and I haven't sold my house. It's like, well, in a stable market, it's 6 months, right? In the old days, selling a house in a month was amazing. So, I mean, we're talking 3 or 4 weekends is all. And so it is starting to get to that more normalized market. When I saw a stat, and, I saw this guy's, and I won't quote it because, I can't remember off the top of my head, but I saw it, and I can pull it up if I have to. Apparently Dallas-Fort Worth, we apparently have year-over-year some appreciation. And I was a little surprised by that, but the article basically said it's the top 10, top 20 markets in America that are making these big headlines when the housing market's crashing and all this stuff. The reality is, guys, Dallas-Fort Worth is great, right? We have so many people coming in from California and the other states that they're propping up our values because supply and demand. We got a lot of people moving to the area that want houses, and they think our houses are stinking cheap compared to what you can get in San Francisco or San Diego or anywhere in Orange County. So it's interesting that it is turning to a normal market here while you read the headlines, and that's the problem with the media is they just, fear sells, so they publish all the big stuff. But locally, Bob, I agree. It's a more normal market where you don't have to pay $50,000 over for a house, and I think you can get a house at a fair value these days.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. I'm talking to Mortgage Mark himself. MortgageMark.com is his website, and Mark Pfeiffer is here to talk a little bit about interest rates and kind of how to navigate in this extreme marketplace we're in right now. Let's talk about some tips for this type of market, kind of what to look out for. Now, one of the things you can obviously do is locking in rates. Pros and cons of this. Let's talk about the process and what people need to know.
Yeah, so a lot of it has to do with the timeline, right? So, for example, if somebody comes in today and has a contract on a house, you got 30 days. At that point, your hand's forced, and you got about 1 week to shop for it. So you do need to lock in the rate, and that is where you pick a lender that you know, like, and trust, and feel really good about it. For those, if it's new construction and it's longer, that's where it's a little harder to gauge. Like, should you lock in today or wait to see what Q1 brings? But as far as locking in a rate, when you locked, you locked. I mean, very few lenders for that immediate 30-day lock, will have this massive flow down policy. So, for example, folks earlier this week, on Tuesday, if they locked on Tuesday, then unfortunately, now the rates are going to be a little better. It kind of is what it is. Now, for us, we've had a floating bias, knowing we thought the big move would be today. I'll raise my hand. I thought the bigger, better movement would be today, but Jay Powell came out yesterday and said some favorable things that really helped us out. So we've been in that floating bias. We've not locked our clients. We've educated them on why we think we should, and we felt really good about it. We're not going to gamble with somebody's rate, but when we have the data that says and suggests here's where it's going to be, we look really smart right now. So it goes back to the working with a true professional. Don't just, and I don't want to pick on them, but the big names and the call center types, again, that's you're going to get a different experience. So when you lock, again, pick a professional like, and trust that can give you the guidance you need.
So let's talk about that situation. You have someone coming in to secure a mortgage, and at the end of the day, it's got to be the individual that says yes or no to it. I mean, it's a real tough one to answer. Let's say rates fall down to 6%. Would you suggest that they lock it? Something like that, just given today's numbers?
Yeah, and again, it just depends on your scenario, right? So it's hard to say. If you tell me today somebody got a contract, as mentioned, right, we've been in a floating bias this whole week, knowing that the inflation report was coming out today, and as predicted by us, it showed lighter inflation, went from 6.3 to 6, and that inflation's bad news for mortgages, guys. So anytime it comes down, that's really good news. The reason why it happened yesterday instead of today is that yesterday Jay Powell came out, he had his testimony, and basically said that he sees inflation coming down, and lo and behold, today's report reflected that, so he looks smart too. But, now it's, do you wait till tomorrow? So if somebody gets a contract today, I'd say let's lock. I mean, we've had really good 2 days, yesterday and today. Now I'm going to say, look, we've seen the benefits. Maybe we might wait till tomorrow. But it really is a case-by-case, and I don't say day-by-day, but it can be certainly week-to-week as far as whether it's a locking bias and what the market gives you.
Let's talk a little bit about adjustable rate mortgages. This is really starting to get gain some energy and some speed here in the marketplace. Talk about what they are, and talk about, are they worth the risk?
Yeah, so ARMs, adjustable rate mortgages, but also known as ARMs, so the acronym for them. ARMs are something, and I'll use an example of a 5-1 ARM. All that means is for the first 5 years, your rate's what you expect it to be. If you get a rate of X, this is your rate. You get it for 5 years. After that 5 years, that's where the adjustable part comes in. So on a 5-1 ARM, it just means that 1 means every year after that 5, it's going to move. ARMs, what's funny, I saw this stat too not long ago. After the mortgage meltdown, Bob, which you and I were both witness to, we lived through it as professionals. But after that, historically, since then, ARMs have only been about 2% of the market. As of the last 4 or 5 months, have now become close to 10%. So ARMs have certainly gained popularity, and the thought and consensus is if somebody gets into an ARM, which, by the way, historically does have lower rates than fixed rates, they're taking these ARMs today thinking, hoping, and believing, and I agree, that rates will come down in the future, and they can then refinance into a permanent rate, thereby saving the difference in interest. The only thing I would say to that is, one, the rate's not always lower, and we won't go into that. I mean, it has to do with what the Fed's doing. Certainly, they impact ARMs more aggressively than the normal fixed rates. And two, what if we're wrong? I'm not saying I know everything, and I can tell you I feel really confident that they will come down. But what if they don't? Right? That's the risk you just have to have with an ARM. Is what if rates don't come down? What if this is the best rate we're going to see? Then you just got to plan ahead for that potential movement in payment.
I was thinking about the volatility that we really haven't seen a whole lot of volatility, but I think we will. And there could be a situation, with the interest rates. And I think that there's a possibility of seeing a really big drop and then a really big increase and this kind of thing. How much would a mortgage rates have to drop for someone, let's say in the last year or so, or just someone who has a 5 to 6% or 5.5 to 6.5% mortgage rate? How much would the rates have to drop for them to go, I think I'm going to refinance?
Yeah, and that's a really good question. And truthfully, my marketing team and we met last week to talk about how we're going to start just amping up the marketing to prevent folks from being taken advantage of and protect the pipeline and protect the people we've known for years that have trusted us. Because, to your point, it can vary. There's no hard rule of thumb that says, because I've heard people say, well, it needs to drop 0.5 point or 1 point. The answer is it can certainly depend. If somebody has an $800,000 mortgage, 0.25% could absolutely, if there's, especially if there's little to no cost for these refis. I mean, if there's a no-cost refi, 0.1 is lower. Somebody wants to do the paperwork. If you don't pay a dime for it, and there's a catch to that, right? Because advertised is no cost and real no cost are two different things. But to answer the question generically, if somebody has questions about does this make sense, we're going to put out a lot of stuff I know in the future, but always call the trusted advisor in your life that does mortgages. We're certainly happy to help. It's a shameless plug. But the reality is call somebody who knows what they're doing and will treat you right, because I promise you, the bigger banks, the servicers, they're your person you're making your check to, they're going to call you and say, hey, it makes sense. Guys, it might, but it may not be the right time to pull the trigger. Because let's say rates do drop, Bob, 0.5%, and let's say it does make financial sense. The question is, should you? Because what if rates keep going down another 0.5%? At some point you're doing a refi and paying unnecessary costs, and that's going to be the trick, coming up in the future. And that's where you got to use that crystal ball in your head to say, is it worth waiting 1 or 2 more months to pull the trigger to make sure you're getting what could be the better, lower rate?
So let's talk about the person who's in this situation. They've taken out a mortgage at a high rate, higher than they wanted to. They realize that things could drop, rates could get better, even from a moment for just a little while to refinance. What kind of things should they be doing to get ready to act in a situation like that?
Fabulous question. It's a real number one thing I would say is first of all, if anybody had any reason for not getting the best rate available the first time, make sure you fix that reason. A lot of times it's credit. Sometimes it may be they put a lower down payment. If they have now money in the bank, maybe you hold off on that bigger Christmas if you think, okay, that extra cash may help you get something better in the future. So I think it's just being aware, and there's no such thing as too soon. Truthfully, Bob, we've already started sending out some refi estimates. Say, hey, here is your trigger point. When this happens, you see the rates hit here, call us, and we'll do the same. I mean, we're in the business of doing loans, so we're going to reach out to them as well. But I think the best thing is have a conversation today So that way, as you see headlines and things pop up, you know exactly where you stand, and you get a game plan of what to do. I mean, it doesn't cost anything to talk to somebody. So if you want to have your credit pulled, again, it shouldn't cost you a dime. You know, the mortgage folks are glad to pull your credit because it just means you're a little bit more obligated to them just on a mental and emotional state. But figure out what you need to do to get your credit right. Figure out what you need to do to make sure your income's right. If maybe last time you got a higher rate because you were self-employed and went a non-traditional route, maybe get your tax returns done early next year. Get them done in February or March so that you're ready to refi when the time comes.
This is Bob Brooks. You are listening to the Prudent Money Radio Show. Thanks so much for joining me today, talking to Mark Pfeiffer. If you want any information on Mark, you can go to mortgagemark.com. Let's talk a little bit about the tightrope that banks walk when it comes to what's the true value of a house. You know, if you've had a property that's appreciated along with the market or maybe even above what the market did, and all of a sudden the market started to come down over this past year, you know, where does that true value lie? And obviously there could be a big delta between that and what a bank is willing to offer for financing. So how do you dance that dance? I mean, that's a kind of a sticky situation.
It really is, and that's going to be the interesting part for next year, right? So if and when rates drop, let's take the folks that bought earlier this year when they were still competing with, 5, 6 other folks, and they paid X for a home. What's interesting is at that time over the last 2 years, I mean, there wasn't a person we talked to, Bob, that said, I'm overpaying $50,000 and I know it's worth it, right? Everybody complains and says, I can't believe I'm doing this, but I'm doing it, right? So the question is, will that extra $50,000 still be, a quote unquote comp in a year's time? And the answer is, mortgage appraisals, when done, if one is needed, which they're needed on most programs, but if they are in fact required, they're going to use comps that have sold within the last 6 months. So if somebody says, hey, I paid X for this, well, it doesn't matter what you paid, it's what it's worth. Now, the reality, like we just talked about earlier, the Metroplex, for the most part, is held value. There's going to be some new communities or something like that where maybe a builder was giving something away because they needed to. But that will be interesting. So to answer the question, how do banks derive the value or how they come up with it? It's a third-party independent appraiser. Like anything in life, there's good ones, there's not so good ones. So it's just making sure you work with lenders, with banks, with institutions that have a really good appraisal panel where they're giving the accurate value, right? I don't want somebody to overinflate something that doesn't exist. I also don't want somebody to be super conservative, but it's doing the right value to make sure it's accurate and indicative of true market value.
Mark, always good to have you on the program. Good information. MortgageMark.com is the website to go to for more information about Mark. Mark, take care and God bless.
Thank you, Bob.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. I was just thinking about, as kind of preparing for this talk with Mark, is just how complicated the real estate markets have become. It's funny because I think, you could look at it and you could make the argument they've become overvalued. You could call it a bubble, whatever you want to call it. It's still, transactions are still taking place. Business is still happening. Nothing is just shut down. It's just a lot more complicated, and that's where that you need to be able to draw a difference between someone who's a salesperson just trying to sell you a mortgage or sell you a house and versus someone who's a true consultant. They're trying to put the best deal together for you. So it's just something to think about. Once again, mortgagemark.com. If you have a question for me, please go to the website at prudentmoney.com and send it in because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.